Hello everybody, Luke Gromen, founder and president of Forest for the Trees. Just touched down in London about an hour and a half ago, so apologize, I'm maybe looking a little rough after a day's travel. At any rate, Happy New Year to everybody. Hope everyone had a great start to the year. Wanted to kick off with our two things that have grabbed our attention recently and get this going again. So two things. First is, I think I would be remiss not to touch on Powell's seeming reversal last week. Lots of discussion about that. I think it surprised a lot of people. My take on that is that I think our research has shown the Fed absolutely understands how important asset markets are to driving the U.S. economy and to driving U.S. tax receipts through both consumption and through tax receipts themselves. 5% of U.S. taxpayers pay 60% of the individual taxes and 30% of the overall taxes, and that is heavily driven by rising asset prices. It's not driven heavily by cash comp. So I think that is number one. I think Powell beginning to, they're not going to go from 120 miles an hour in one direction to 120 miles an hour in the other direction. I think this might have been a very important moment in terms of potentially moving towards a more wait and see based on what asset markets do, because asset markets are so important. The second thing that really grabbed my attention, and you go from from macro to micro, if you will, just saw that over the weekend, U.S. heavy-duty truck net orders were down 43% year over year, lowest number in 2 years. During my nearly 20 years on the sell side, we always followed heavy trucks being in Cleveland, Ohio, and the inside baseball read is call it 60 to 70% of the dollar value of goods in this country, in the United States, are shipped via truck. And so a very good leading indicator has always been the heavy duty truck industry. And so you've seen China slow down, you've seen emerging markets slow down. U.S. is now catching it. So, and I think that probably also has something to do with Powell beginning to maybe back off. So I'm going to open up for a few questions for maybe 5-8 minutes, and then jump off and grab some food and see what's going on. So let's check in here. So Powell, so the Fed blinked, in my opinion. Yeah, I do think they blinked. It's hard to overstate how important asset markets are, and I think it's particularly given the context of where we are, which is in the next recession or crisis, whenever that happens, things are likely going to get very, very weird by virtue of where global sovereign debt levels are. We are in a global sovereign debt bubble, and you really can't have a problem anywhere without starting to sort of set off those explosives, if you will. It's something we've talked about a lot, but that, I think, is ultimately why they are, quote-unquote, panicking in some people's eyes. Do I think they will cut rates in 2019? I do not think they will hike rates in 2019. That's strong. Let me rephrase. I do not think they will hike rates more than once in 2019. So I don't think the markets have this wrong. And I do think it is very possible that if they do hike rates early in the year, I wouldn't be surprised at all if they are growing the balance sheet by the end of the year, which I think is probably a pretty divergent view at this point. But when you look at, again, the context of a global sovereign debt bubble, and a slowdown that is now happening all over, and some of this slowdown is just business cycle, and some of it is the trade stuff. So some of it's sort of in the Fed's control, some of it's not in the Fed's control. When does the dollar top, in my opinion, then? I think I think what we've seen is a dollar bounce, and I think the big move we saw in the dollar short squeeze took place from 3Q14 when it went from 70 or 71 to 103 on the Dixie by call it 3Q16. We had 4Q16 through early 18. You had a dollar sell-off. And we've had a bounce, but I think this bounce has probably, maybe it could retest 97, 98, but boy, I think, I just think now that sort of, the bombs the Fed have been dropping are hitting really close inside Powell's own bunker, if you will, which is something I tweeted about last week. I just think that we're, that game is largely done in terms of rate hikes, and when you start taking out the rate hikes, that really starts to change the narrative on the dollar. In theory, if you go into a recession, that has historically been dollar positive. The question, though, is will it be dollar positive this time? 2001, yeah, the dollar ran in a recession. We had just gotten done running 2 or 3 straight years of surpluses as the United States, and clearly we're not doing that. 2008, dollar ran into a recession. Clearly understand that. Then again, nobody knew the Fed and other central banks would print it all, and everybody knows that now. So there's some reflexivity there that I think investors need to consider in terms of if we do go into recession and the dollar should run, does it run like it did in 01, 08? I probably would say no. Hi Andrew, what's the importance of the bid to cover in Treasury auctions, and what's the implications on Treasury liquidity / risk off assets? It's a great question, and I wrestled with having this be one of the two things. Even though the 10-year Treasury yield has come in significantly, and quite frankly more than I would have thought it would have done, it came off because we had the worst December, in no small part because we had the worst December in 87 years since the depths of the Great Depression. And so if it takes us having an October, November, December sell-off just to get 70 basis points down on the 10-year Treasury, and by the way, we're still up year over year, that's not a trade we can make. You can't trade down equities for only a slight rise in the 10-year Treasury. That just does not work for the math. The bid to cover thing, though, is really interesting because, in theory, if there was this flood of capital and the Treasury drove yields down, the auctions should have been very well bid, and they weren't. They were pretty sloppy, in fact, and I think that speaks to, under the surface, still some issues on the supply side. Could have been time of year. December's a little soft in terms of people being away, but the bid to covers were some of the worst in decades or ever, in the midst of a very big risk off. So something we're watching going forward. Hi Doug, yuan oil contract working? ? Yeah, it's working. Ole Hansen at Saxo Bank had a great chart. We retweeted his tweet, which was you're seeing not only volume in the front month continue to gain share, you're also seeing open interest not just rise but also broaden from the front month to the front 3 months. So I do think it is continuing to gain to gain traction. How much cash should we go to? Hi Jason. Gun to my head, to me, I think the market sell-off was not just a fluke, number one. I think there are some very serious issues that they're beginning to discount. That said, you have seen the markets go from everything is awesome to end of the world remarkably fast in a lot of different indices. And so, to me, I wouldn't be surprised if you get a bounce. That said, the $64,000 question is what does the Fed do? What's the dollar do? If they do something with the dollar, or if they do something with the rate hikes that weakens the dollar, I don't think I think markets will do quite well like they did in 2017. If they fail to do that, if they sort of go back to doing rate hikes and the QT, then I think all you're going to want to own is cash and gold. It'll be the only things it'll be safe in. Let's see here. Gold oil ratio comments. Hi, Andrew. It has been people saying, hey, China's got a current account problem. If it's in a deficit, they have a problem, and that's absolutely right. That said, they understand that if they price commodities in yuan, they won't have a current account problem. And you start settling the yuan oil contract in September. Oil goes from 75 to 45, and guess what? China's current account position's a heck of a lot better vis-a-vis commodities and overall with oil at 45 than oil at 75. Let's see here. Gold and Aussie dollars closed last month at all-time highs. A signpost. Hi, Dave. I'm here in the UK. Here in the UK as well. Yeah, I do. Look, I do think it's a signpost. I think you're seeing gold do pretty well and rise in a lot of different currencies, and pretty much every. I think it's indicative of issues in Australia specifically. But as that spreads, that's a lot of guys would tell you, hey, that's really a gold bull market when gold's rising in all currencies. Let's see here, a couple more, and then I'm going to jump. So the Fed has to choose either the dollar or the stock market. Great way of summarizing it, Abdul. And yes, I think ultimately. That speaks to what we've talked about with our U.S. trilemma, which is that if global central banks will not sterilize U.S. deficits, then the U.S. has to choose two of three of a rising dollar, rising rates, rising stock market. They did a remarkable job, a better job than I would have thought, with basically being able to pull off the dollar milkshake with rates up, dollar up, stocks up, from call it April through September. Our case all along had been it's not sustainable. They sustained it longer than we thought they would. But like I said, I don't think the October-November sell-off was a fluke in the least. There's some serious underlying macro stuff happening. So I will touchdown. The Bears just took the lead. So I've not seen any U.S. football all day. But at any rate, I'm going to try to go catch up on a little bit of that and catch in. I've been on a plane for much of the day. So sorry to make this so quick tonight, guys, but I appreciate you hopping on. And we're in the new year, so I'll be back in the States next week and definitely look forward to seeing you guys next Sunday night. So everyone have a great week this week, and we'll talk to you soon.